Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello, and welcome to this episode of XYPN Radio. I cannot believe we are already at episode 16. Feels like just yesterday we were recording and launching our launch week of 7 episodes in 5 days. So very honored that you have chosen to join us today, and hopefully you've been able to check out a few other episodes. If not, you can go to xyplanningnetwork.com and check out some of the other episodes that we have recorded in the past. So this episode features Steve Lockshin, who is the co-founder of Betterment Institutional. I wanted to dig in a little bit and learn more about Steve's career, because if you're like me, you may not have heard Steve's name very often, especially not in the RIA space. But he has actually made a pretty big name for himself, because he started an RIA that was managing over $15 billion whenever he sold his shares in that company. And he also started a TAMP that was managing over $80 billion when he sold out. And he has since gone on to start a new RIA called Advice Period, and honestly has kind of become a household name in the fintech space. So the financial technology investing space, he has invested in probably over a dozen fintech companies at this point, many of which you know of, many of which are partners of XY Planning Network and are included in the technology stack that we provide our members. So Steve has a really great perspective on the effects of Robo advisors and what effect they're going to have on our industry, especially because he is building his new RIA Advice Period to leverage really the value that the Robo advisors bring to the table. And he kind of has an insider's perspective on technology in the financial planning space. So it's fun to chat with him about it. This month's shows are brought to you by BettermentInstitutional.com, the advisor-branded digital platform that automates the operational side of your business and lets you do what you do best, advise clients. Schedule a demo at www.bettermentinstitutional.com, and you can also listen to our interview with Steve Lockshin, the co-founder of Betterment Institutional and the platform's first advisor client, at www.xyplanningnetwork.com/16. All right, without further ado, here is my interview with Steve Lockshin, co-founder of Betterment Institutional. Hey, Steve, welcome to the show. Thanks so much for being on.
Thanks for having me.
So you are a little bit different than some of the other guests that we've had on, because you kind of play in a little bit different world than most of us know. So I'm really excited to have you on just to talk through some of your career, some of your different, some multiple firms that you've been a part of building, as well as some of the technology investments that you've been making and building and that sort of thing. So I'm really excited to see all the different places you have your hands involved in. So just kind of give an introduction. I don't even know how to introduce you, because you are the co-founder or founder of so many different things. So how do you normally introduce yourself to advisors?
Oh, guys, it depends on who I'm talking to, but I think I'm generally introduced. Mike Durbin from Fidelity did a great job one day introducing me to about 300 execs at Fidelity as an industry agitator.
Oh, there you go.
So I kind of like that name, but for the most part, I've tried to stay on the cutting edge of what I think is going to happen in our industry. If anything, I've been early in lots of stuff, which is sometimes painful, but I think industry agitator is a good way to go.
I wonder what it will take for me to get there. I'm working my way towards there, I think.
just annoy a whole bunch of people and
just keep pissing.
They'll come up with
pissing
names.
People off. So, how did you get into financial planning? Has this, or kind of in the industry in general, has this always been your career path?
I won't torture you with too long of a story. The short answer is yes and no. It's been my career path since my college days, but I was supposed to be a doctor. Decided I didn't like it and didn't like the school part and didn't know anything about money, but got an internship with my girlfriend's father's best friend, who was a top producer at one of the wirehouses, and fell in love with the business very, very quickly, and ended up in the business after years of interning and working for a Wall Street firm, and years being when I was 21, I had already had 3-4 years under my belt and hopped into the business.
So kind of discovered it early on, and then were you doing actual financial planning at that point, or was it all on the investment side?
I started out doing the books and working in the wire cage, and then I was an assistant, and then I ended up on the muni bond desk. But I left. I was going to go to law school, and while I was waiting for school to start, I went to work for one of the top insurance guys in the country. And that's where the estate planning part of the business was originally developed, because that's what he sold. Anybody can sell the same insurance policy, but how are you going to get people to buy it? And he was heavily focused on estate planning. One of my clients was very wealthy and had a very complex life, and said, "Can you help me simplify my life?" And that became my first client. And from there, it turned into a business.
I love it. Whenever you say wire cages and muni bond desk, it just makes my skin crawl, because that is not my background, but I understand that's really where planning came out of. I mean, this was kind of the first generation of kind of almost discovering financial planning, because you all of a sudden are asked to do a little more, and suddenly you're doing comprehensive financial planning and didn't even realize it.
Yeah, although it's interesting, my experience was, and I still think very much is on the street, that any of the planning was really just a mechanism. I won't use a derogative word like ploy, but for many it was a ploy, but it was a mechanism to sell whatever product they were selling, and that's how they were paid.
Sure.
And one of the things that propelled me into the business was just being able to sit on the same side of the table as the client and give them advice that was unconflicted. And that really didn't exist in the late 80s when I started this.
So at what point were you able to get yourself kind of broken away from the product side and really just focus on giving of advice?
It was really when I left the insurance business and started with this family. So in 89, I was doing both. By 94, we had decided there was enough opportunity to create a registered investment advisor, and there really were not a lot of independent advisors that weren't money managers back then. So think of it as a family office for folks with less than hundreds of millions. And that's what we rolled out in April of 94. We launched, and most people said, nobody's going to pay a middleman. This is a ridiculous idea. And that happened for a while, but it was very easy to start to demonstrate value, and the business grew quickly.
You know, it frustrates me so much because, I guess probably about 10 years before you were doing that was really the initial fee-only movement in general. And I think a lot of y'all were doing this independently and didn't necessarily know each other, because this was before we could just interact on Twitter. And yeah, everyone said it can't be done. No one will pay for advice. No one will pay for planning. You've got to wrap it up into the commissions. And of course, a lot of you said, no, I think I could do this. I think clients will pay me for good advice instead of product sales. And yet those are the same people that are telling our members, no one will pay you a monthly fee for financial planning. Why would they ever do that? You've got to wrap it up into the investments. You got to wrap it up into the AUM. So it's kind of funny how those folks have come full circle. I think they're finally starting to see the light, but it has been a little bit of a frustrating path for folks that aren't, I don't know, you probably thrive, correct me if I'm wrong, but you probably thrive off people telling you something can't be done whenever you know it can be.
Yeah, I think that's the nature of an agitator or disruptor is going against the grain. And you get tremendous energy out of finally going, yeah, you're right. Sometimes it takes you down a rat hole because you don't want to let go of something. But it's tremendously rewarding to do what you think is right and then ultimately see it succeed.
See it work. No, it's probably really good advice is watch out for those rat holes. But anyway, so you really got started because you had the one family that, needed a service. And so kind of got started with them and then really started to grow your RIA. So before the call, we kind of went through the progression. So tell me again, the progression of how did that, starting that RIA lead to kind of where you are now?
So in 94, we launched. Like anything, it took a little while to get to the first 100 million. And then I remember the first billion, and then it kind of started to ramp up from there. So by 2001, we'd grown to a decent size and decent profits, and we sold to a privately held financial holding company that also had a bank. By that time, we had started our back office business, which ultimately became Fortigent, TAMP. In 2007, we'd outgrown that institution. We were by far the biggest part of it and sold to City National Bank. And that was the beginning of Convergent Wealth Advisors. Same business, same team, different name. Fortigent stayed separate. In 2012, that got sold to LPL. And then in 2013, I'd kind of run out what I would say is my stay at a large corporation. I don't make a good pet, as my old partner used to say, and decided to start a new company, which was Advice Period, which is our RIA, and simultaneously had already started investing in some fintech companies, Betterment being one of them, and had pushed them to adopt a institutional model, which we're excited about. So that's the last couple of years has been exciting, and it feels like 25 years ago, the Wild West.
Yeah, I mean, it's just to point out, although the last couple of years have been exciting, and those are the pieces that we're really focused on. I mean, you really built a heck of a business. I mean, you were telling me the Convergent and all of the different entities and pieces. I mean, it was up to almost 15 billion AUM at one point. So just so listeners know how big of a scale we're talking about, you took it along with others, of course, but from one family to a $15 billion RIA, or I guess RIA, or I should say $15 billion umbrella.
Well, really, that was just the RIA. I mean, the TAMP had 85 billion of assets on top of it also. So they were separate businesses.
Oh, okay. So I did not realize Fortigen was that big. And now, does Fortigen still exist in its TAMP form?
It does. Okay. It's owned by LPL. But yes.
Okay. Yeah. And for myself and our listeners, this is a little bit outside of our world. Anything that goes over about $1 billion starts to get mind-boggling. So for an $85 billion TAMP is awesome. Is there a particular angle there with Fortigen? I mean, is it a actively managed TAMP, DFA? What's its kind of stake in the ground?
I think today Fortigen is what it's been the last 5 years or so, which is a reporting and research institution. So advisors can do whatever they want with respect to the portfolios. They offer active, passive, a lot of alternatives. We had a heavy alternative focus for a very long time. We were early in that space, but reporting was probably one of the things they were best known for.
And like the vast majority of advisor TAMPs out there, probably have pretty high minimums. I couldn't just start an RIA off the street and get tied in with those guys, I'm assuming.
Correct.
So you decided to go off and launch your own RIA. Did you bring a bunch of clients with you, or did you just kind of start from scratch?
Well, I started from scratch knowing that a number of clients would follow, but also didn't want to decimate the company that I had helped build.
Sure.
And so worked out an arrangement with Convergent that would be, I don't love this term, soft landing, but basically allow me to exit gracefully, and worked out an arrangement that was economically beneficial for both of us, where clients that they knew would leave could leave and come over to our firm. And then obviously we were motivated to bring in new business. So there's a handful of large clients that were very tied to me that we started with, but otherwise it's been new business.
Yeah, and it's definitely something that a lot of our listeners are dealing with as they're breaking off and trying to start their own firm, is that they do have these, either very strict non-competes or they have a buyout clause or whatnot, and folks are always trying to find ways around it. And I'm like, don't do it. Just follow whatever you agreed to. If it's 2x revenue for anybody that comes with you, just pay it, and finance it or do whatever you got to do, because ultimately those relationships are worth a heck of a lot more than 2 times gross in the long run.
Yeah, so is their integrity. I mean, it always pays to take the high road, and it always pays to have an honest discussion with your employer. It bothers me tremendously when people leave, take business that they were paid to cultivate by that institution and pretend like it's theirs. And so I have tremendous respect for people that honor their arrangements or have honest discussions about it. And I don't have a lot of respect for the people who just take up and steal the business, if you will. And that's a strong word, but that's how I feel about it.
That's a really good way of framing it, because while there are certainly a few in that kind of eat what you kill revenue model, not very many. For the most part, folks are still being salaried and getting compensated and, extra bonuses and things like that when they bring in business. So the company is paying them to bring in that business, and that was their job. So that's a really good way to look at it.
Yep.
So let's talk about Advice Period. Where did the name come from? Because it's kind of unique.
I was racking my brain. I'd probably gone through 100 names. And once you come up with a decent name, you still got to see if the URL is available, if the trademark's available. It's really tough these days to come up with a name, as we see with all these tech companies coming up with interesting names.
Just a bunch spellings. Of letters together, making words up.
And I was sitting in bed one night and thinking, we want to provide advice, period. That's it. And I said, Advice Period. Let me look that up. Sure enough, the URL was available. We were able to trademark it and said, great, let's go with that. And it really was an epiphany like that. And It's polarizing. Some people love it, some people hate it. But as soon as I explain the name to folks who are a little about it, they're like, I get it, I love it. So it's descriptive.
Just out of curiosity, do you find that just saying like we just give advice, is that more industry speak, or do you find that also to be client speak and something that they're actually looking for?
I think it's client speak. I mean, you can put it to any consumer. I use buying a car as an example. If you go to a car dealership, other than places like Tesla, where there is no negotiating, but you walk into a car dealership, it's a negotiation. You do your research beforehand. You see what the best discount is. You can get it at different places at different prices, but you're walking in a dealership knowing you're going to get screwed. You just are not sure by how much. And it's not a great feeling. It's so much easier to buy something and know what you're getting and know you're paying a fair price. And so when I describe it that way to clients, and the vast majority of our revenue is flat fee revenue, it's not AUM based. They love it because it's clear. They know what they're getting, they know what they're paying, and they can make a business decision on whether or not it makes sense.
So let's talk about that a little bit. How is your fee structure set up? So it's not based on AUM. So how do you determine the actual flat fee arrangement?
3 factors go into it. The first is how much value can we add? And we cater to, although we have no minimum, we cater to very large clients. So let's say there's 2 $50 million clients. One is a $50 million techie, single, just sold his business, very charitable, and believes in passive investing. Pretty simple, one account, easy to use. Throw them on the Betterment platform, and a lot of the work is automated, and they're very happy. The second family is old school, 5 adult children located all over the country. They each have 10 million. They want to be treated like individuals. They want alternatives, complex reporting, face-to-face meetings. They have very different complexities and also different needs. So you can add different value in each of those. You've got different complexity. So those are the first 2 components. How much value can we add? How complex is it? And then the last, smallest component is a small factor for size, because if you make an error on $1 billion account versus $1 million account by typing in the wrong symbol, you got to eat that error. So there's a small insurance piece, if you will, to cover the risk, but it's predominantly driven by those first 2 characteristics.
So can you tell me a range, like kind of what your smaller clients are at all the way? I guess that's really what matters, because you probably have clients all the way up the food chain. So.
Yeah, well, what we say is if you're in the accumulation phase, because we don't know what it's going to look like, and you're below 10 million, we'll charge 85 basis points. Okay. And so that piece is AUM driven. But if you're not in the accumulation phase, and it doesn't matter what your size is, then we know what your needs are, then it'll be flat rate driven. So it could be anywhere from a very low fee of $5,000 to $10,000 a year, depending on the size, all the way up into $500,000 a year fixed fee.
So are you seeing that the industry is going to ultimately move towards this flat fee kind of away from AUM? Or I guess what's your opinion there in terms of the industry shifts, if any, around fee structures?
I think our industry is slow to move in any direction. What do I think is right? I think there's no perfect answer. I like the flat fee arrangement more for the reasons I just described, and I hope it moves in that direction, but it'll take time for folks to get there. So just like the car industry has remained the way it has, even though we all go in with that feeling, and Tesla certainly has made its mark, it's going to be a long time before the entire industry adopts a new pricing methodology.
Yeah, I was chatting with JD Bruce out at Abacus Wealth Partners, the firm that bought my RA, and he said that, he perceives a frog in boiling water issue here where we're all going to say that, and then one of these days we're going to wake up and be like, oh crap, look where the industry went without us, for those that didn't jump on board. And I will say, and feel free to disagree with me, in our last episode with Michael and I co-hosted, and we were talking about kind of the shifting of industry trends. And my prediction is in 10 years, AUM is no longer the dominant fee structure in our industry. simply because it only serves such a small subset of the population that we have to have something else. And I don't know if it's flat fee or monthly retainers or some combination of hourly and retainers and project-based and flat fee, whatever. Ultimately, though, we'll never be a profession until we break kind of the bonds of AUM because, again, it only serves an incredibly small subset of the population.
So I will agree and disagree with a couple points. I think that 10 years is too short. I think it could take 20. It's taken 25 years just for the independent advisory space to really become a decent player. And I think it will take probably another 20 years for the fees to change. I think in terms of assets, you're right. I think in terms of number of clients, there'll still be a significant amount that are AUM based because they'll be in the accumulation phase. And it's tough to flat fee those folks unless you just adjust the retainer every year. So I think it's just going to take a bunch of time to really get folks to grab it. What I hope is that consumers start to understand stuff and drive the change faster. That would be ideal. And that was kind of how I finished the book I wrote a couple of years ago about this, which is, hey, you're in control. Vote with your wallet and you can make this change happen. And that's what I think consumers should do and hopefully will do.
So do you think that companies like Betterment or Wealthfront or any of these, quote unquote, robo-advisors, I'm not a big fan of the term, but everyone uses it, so that the robo-advisors will cause fee compression on the AUM side and ultimately shift our industry towards flat fees? I mean, do you think they're going to have a real effect there, or do you think that's just a fear that advisors have?
I think it's a fear that advisors have. I mean, today there is no real transparency across the board in fees. We all talk about 1% is a typical, but I see fees all over the board, and the services do not match the fees very often. It's really whatever people are confident charging. They sell whatever they can sell, and people are buying at. So I don't know if the robos will help drive the fees down, other than saying, hey, you can get these commoditized services for a very low price, and that will set the price for those things. Until there is a easy mechanism for consumers to compare solutions, I think pricing is going to be all over the board.
Yeah, it really isn't transparent. So we had Eric Roberge on back in episode 6, and he's a Betterment Institutional user, and we'll talk more about Betterment Institutional, but he has shifted all of his clients over, and he charges around, I think, 90 or 95 basis points for the advisory fee, with 25 of those basis points going to Betterment Institutional. Now, that 25 basis points covers all the transaction costs, custodial cost, all that sort of thing. And then he has his fee. And then the underlying cost of the Betterment Institutional platform, it's all Vanguard ETFs. It's probably 7 or 8 basis points, depending on, what your risk tolerance is. So all in, his clients are paying just over, we'll say just over 100 basis points, just over 1%. And I've heard other advisors say, yeah, but I charge 1%. It's like, yes, you do, but you're also using mutual funds that the industry average is 1.2% on expense ratio, and you have transaction costs. And sometimes you have custodial platform costs, but hopefully not if you're of that size, and your advisory fee. These clients may be paying 2.5%, 3%, and yet both of these advisors are saying 1%. So you're absolutely right that there is a huge lack of transparency there.
And it's going to change. I mean, just if you remember when the iPhone came out, it was one of the first devices that didn't have an instruction manual with it. And it started to move to a much more intuitive nature with respect to explaining how to use it. And I think that's what needs to happen in our industry when people can tell the difference. I had suggested a while ago, if you have a conflict of interest, you should be called a broker. And if you have no conflict of interest or no economic conflict of interest, you could be called an advisor, and the fees should always be separated. And we've seen that pendulum swing in the UK and in Australia, and it's caused some major shifts. And the pendulum always swings a little bit too far. So it'll be interesting to see how this plays out long term.
Yeah, I definitely hear folks say, and we're hearing it with the Department of Labor stuff. If we can't get paid commissions, we can't serve smaller accounts. And we're sitting here going, now, wait a minute. We've got 150 advisors that are thrilled to serve smaller accounts for a flat monthly fee that the majority of Americans can afford. We've got platforms like Betterment sitting there that are happy to help you on the investment side and don't have investment minimums. So why can't we, serve them? So it'll be interesting to see. There's so much going on right now politically. I think it'll be really interesting to see how all this shakes out.
Yeah, and why can't the advisor, if their commissions average 1% a year, why can't they just switch to a 1% fee a year? They don't have to have commissions in it.
Well, that's because their commissions are actually 5%, and they don't want to tell their clients how much they're paying.
Exactly.
Because, I mean, I understand it's the 1% discussion is tough. I can only imagine trying to have a 5% discussion to say, all right, client, you got a $50,000 Roth IRA and we're going to charge you $2,500 to help you with it. And then as soon as we help you, we're going to turn you loose because we've made our money. We don't need to help you anymore. Yeah, the only way they're doing that is because they're wrapping it into commission. So you have told me before about this, but you had this philosophy when you started Advice Period that you wanted to be the firm of the future. Tell me a little bit about what that means to you. What are you building that makes it the firm of the future?
I think it's really three things. One is the tech stack, which we can come back to. Two, it's the culture. And three, it's the experience that we give the client. So working backwards, the experience is moving away from a quarterly meeting where we show up with a 40-page deck with a bunch of charts and blur them into submission with data where they just want you to leave, but they're there out of obligation. And having more video conferences or maybe an annual review with bigger picture items and then more infrequent meetings that are episodic as things happen in their life. So we become more engaged in their life. The office culture is, we look more like a tech company if you walk into our office. And I usually use the example, if your little brother or little sister come to you and say, hey, I want to get in the business just like big brother or big sister, and I'm trying to decide between these two companies, and they happen to be located right next to each other. And so I drove over there the other day for my back-to-back interviews, and I wasn't sure where to park because one of them had a Tesla hooked up to their electrical charging station in front of a really cool contemporary building, and the other one had a horse and buggy out front tied to the post, and I'm just not sure which one to go work at. And, it's my way of making fun of, do you want to go old school and not adopt the new ways, being on the cutting edge and have a different experience for your clients? Or do you want to kind of go old school, mainline, to me, boring? And I think the culture that we want is we want smart folks who want to do things different. And then we can talk tech stack, but that's a big part of it.
You make a really good point there, is that this is the experience for the client, but it's also the experience for the advisor. And, there's this fear right now, and there should be, that we don't have enough young talent to replace the old talent that's leaving, kind of to replace the old guard. And if you're looking to recruit, I would hate to have an old school advisory firm across the street from yours if we're trying to recruit top talent, because ultimately you're going to get the top talent and I'm going to get, the B team. And so allowing your firm culture to kind of come into the new age is going to be something that allows you to recruit that top talent. Because I will tell you, having worked with, just in the last month, spoken to most of the major financial planning university programs, just kind of did a bit of a spree of webinars. They're hungry for opportunities like your firm. And yet there are so few firms in this space that are willing to let people wear jeans and let people work with younger clients and do stuff via video conference and with technology, that anyone who is doing it is going to be able to recruit the top talent.
Yeah, we have unlimited vacation. That's unheard of in our industry, very heard of in the tech industry. We encourage people to work from remotely. Everybody in the office has a MacBook and they can move around and work any place they want. So it's a very, very different experience than the high-walled cubicle, suit-wearing, 9 to 5, 2 weeks off a year type of environment. And hopefully that will attract the best talent.
I think it will. And so XY Planning Network is actually set up the same way. We have staff in 6 different states, all different time zones. None of us live in the same area. Everything's virtual, unlimited vacation days and that sort of thing. And I get pushback to say, oh, well, but you're not a financial planning firm. It's different. You have advisor members instead of clients because, like advisors have different expectations than our clients do. So it's good to hear that there are financial planning firms doing the same thing. There are a few out there. And it's nice to see that you're doing it honestly on the top end, and a lot of our listeners listeners are going to be working with younger clients and lower fees than necessarily what you're charging. But I would say that the argument now is that, we could do that. It makes sense for millennials that want to pay $150 a month and meet virtually. But older, richer clients, no way would they pay, big flat fees and work with someone in their jeans, virtually. And you're proving that that's wrong.
It's wrong on so many fronts, even on the technology side. When we talk about Betterment, if I can go back over there for a second, where folks say, this is great for small clients or great for young clients. Older folks don't get technology, or they still want someone showing up in a suit and tie. And my question is for everyone, how old are your parents? And if they're in their 60s and 70s, even 80s, do they have an iPhone? And the answer is typically yes.
Yep.
And so then they're not afraid of technology. My parents are mid-70s. My dad's on his Mac and his iPad, and he's doing programming, and he loves this stuff. So, and he's a doctor. So they don't dislike that experience. It's advisors who get in the way of adoption, thinking this is what it needs to be like. What I find, even my clients that have been clients for 20 years and saw our old school way of doing things in the progression, they like dealing with a contemporary firm that says, yeah, we're willing to change. So I went from having all active when we started, because we didn't think we could really sell passive, to really having a almost religious change that we're predominantly passive and almost exclusively passive for most folks. And I was able to say to clients, hey, things are different. And we're changing with the difference. And they like that, as opposed to being afraid to go to them and saying, we can't change. We have to do what we did yesterday.
So wrapping back to Betterment, why partner with them? Why go that direction? You'd already built a TAMP before. Why not just build a new one that did some of the things that you wanted it to do?
There were a couple of things that all came together. And with anything, luck always plays a little bit of a role. So around 2009, which was 2 years into my gig with the larger company, I was already getting restless, and I started looking for other things to do, and was always an early adopter of tech and tried stuff out. And I started hearing about Betterment. It was probably one of my first social media interactions that I really got something out of. I linked into John Stein and said, hey, this is, I think, 2011, 2012. I said, Top Barron's producer or advisor, I'd like to come see you and think what you're doing is interesting. Went up and visited with them, loved what they were doing, really only had one or two other kind of due diligence calls, and said I wanted to invest in the company. And this was between their seed round and their A round. And wrote what was the largest check for me for venture investment with probably the least amount of research. And this is where the luck comes in. I just thought they were going to be disruptive, and I liked that they didn't come from the industry. So I had a fresh approach. And right around then, the access to cloud computing, the cost of computing coming way down, the intersection of all of these things, the fiduciary opportunities, the access and simplification of information, all these things made it very, very interesting. I originally thought it would be disruptive, but very quickly changed my mind and thought this could really help out advisors, and started pushing for what is now Betterment Institutional.
Okay, so you actually invested in Betterment itself, not just Betterment Institutional.
Correct. In fact, Betterment Institutional is not a separate company. It's a line of business for Betterment. So my ownership is in Betterment that encompasses the whole company, and then our partnership is in distributing the Betterment Institutional platform to advisors.
Now, this is as much for my education as listeners. So you said between seed and Series A. So this is a different world for most of us advisors. So could you just briefly explain, is seed funding the initial round of angel investing?
Yes.
Where do all these pieces fit?
Yeah, Betterment had an initial $3 million investment from Bessemer Ventures. And that's, I'm sure they had some angel investing first to help them get going, but that was really the first round they had. And then the first institutional round, the Series A, was a much larger round. I can't remember the total amount, but I think it was maybe 10 million. And then it's grown from there.
Okay.
So,
because they've raised something where, 100 million or something like that, or maybe more than that.
About 105.
105, okay. And then do you run out of series fundings? Like, is there a letter that you have to stop, or can you just kind of keep raising funding? How does that work?
It's an interesting question. I mean, the world is changing. So the ultimate evolution was usually an IPO. But now you're seeing companies like Palantir raising rounds at, 15, $20 billion valuations and continuing to raise. So I don't know what the future holds, but being public is not only expensive, but it creates, again, some conflicts of interest that go away if you can stay private. And there's plenty of private money that wants to invest in growing companies.
So thank you for that, because that's something that it's kind of outside our world. And here in Bozeman, Montana, we don't talk series funding all that often. To be fair, though, that they just ran in the newspaper, we're getting fiber, we're getting the 1 gig internet or whatever. So that's exciting. Us in Austin.
Well, good. Then I expect you to reply faster.
Faster emails. So you invested the money in Betterment and kind of started to push them on this institutional side. Again, this is something you could have theoretically gone out and tried to build yourself. Did you just see that they had the attitude, the team in place, and they were just already doing it? Or is there just something about their sauce that you really liked?
The product was, very different than it is today because it's continued to mature, but it was already a fantastic product and it was well thought out and they had a team. Culture is very different. And I mentioned early that the fact they didn't come out of our industry was a positive. And while I think that I can generally step away from the industry and try to be forward thinking, it's very, very difficult not to let your past experience influence your thinking on a go forward basis. We see it with the industry all the time. I see it today with advisors just over the last couple of years refusing to adopt Robo. It's us versus them, Terminator style. And now it's like, okay, well, maybe it's not us versus them, but we don't need it. And slowly we're seeing firms adopt. And I think in just a short period of time, we've seen a big attitudinal change, but we haven't seen the adoption that I think we'll see in a year, 2 years, 5 years. And so I like the fact that they had completely fresh eyes on this business.
So started pushing towards institutional. Tell our listeners, what is Betterment Institutional then? Because Betterment is the Robo for retail investors that want to, get their money invested in a really low cost, really efficient manner. I think we're all fairly familiar with Betterment, but what is Betterment Institutional?
Well, what I say Betterment is it's the democratization of the commoditized part of the business. That used to be if you had a small amount of money, you typically paid significantly more as a percentage of your assets to get significantly worse products and experience. Where here, whether you've got $10 or $10 million, you get a very, very similar price and experience on the DIY side of the business that is Betterment. Betterment Institutional uses that same platform to allow advisors to not only accelerate their practice, but to eliminate the inefficiencies in the back office. And so I really look at it as a platform to create time and for advisors and a better experience for their clients.
I've kind of always viewed using Betterment Institutional is almost like hiring an investment guy and an admin guy to sit in your office, because they're doing all the account opening work, the transfers, the rebalancing, the research, all of these pieces are taken care of. But especially if you're a startup, you're paying 25 basis points. So, you pay as you go, as opposed to having these big salaries for these really smart people. And obviously you're getting, I think, a lot better service and a lot better people than if you just went out and tried to hire someone yourself to sit in your office.
Yeah, I actually even take it one step further. So I feel, and I encourage advisors to have the clients pay the platform fee, not even to have the advisor pay the platform fee. And there's a couple reasons. One, clients typically pay their transaction fees anyway, and the transaction fees are part of the platform fee. Two, for the taxable client, the tax loss harvesting is worth the fee alone in spades. I just look at my all equity account that has built-in gains because I started it way back when, and even still last year it harvested roughly 8% of the corpus of my portfolio. And I live in California and I'm in the highest tax bracket. And so if you assume I have short-term gains, which I do, I can use all of that. So that's worth 4% to me and with no increase in risk. And then since I'm charitably oriented, I can actually give my low basis stock away, my low basis ETFs from the tax loss harvesting. So I never pay the cap gains. So I get the full impact of the tax savings. And then even last year, having harvested those losses, I'm back at another 8% already this year of my corpus and harvested losses. So that's 400 basis points against a 25 basis point fee with no transaction costs. So I think it is very, very much worth it. My clients of all sizes pay the fee, and then I charge my normal fee on top of it for the value that I add. And so that's the part about the fee. In terms of the back office, you just can't replicate, even with people. I don't care how much you spend, the time savings. So we've actually measured it because we started with traditional custodial servicing because Betterment Institutional wasn't available when we started Advice Period. And we still have some things that don't fit on Betterment Institutional as of today's technology. And if a client walked in today with $1 million of cash in their account, not literally in cash, and said, I need an individual account, a joint account, and an IRA. It would take us between a half hour and an hour for each account to do the paperwork. And if they had any rebalancings during the year or just typical cash flows, we figure it's a 10 to 20 hour per year administrative process for that client in the first year. And then each year thereafter is probably about 10 hours. With the Betterment Institutional platform, now I can populate the form for them, send them a link. It takes them about 2 seconds to click the link. It takes us about 2 minutes to populate it, and I'm done. Everything from an administrative standpoint is now fully automated. So think of that per client, 10 to 20 hours a year going down to basically nothing. That's the benefit.
And even in a smaller firm setting where you're working with 50 to 100 clients, I mean, we're talking about well over 10% of your time. And I think the only reason that your numbers are as low as they are is because you truly are passive. I think the folks that are we still have a lot of folks manually rebalancing using Excel because they can't afford some of the better systems, getting in there and when cash, especially for accumulators that are saving money, trying to figure out when does it make sense to buy, or decumulators taking money out. Like, I think 20 hours is only because you have a larger firm that is highly efficient.
Yeah, it's crazy. And take it one step further. So with the volatility that started in late August, we had days with massive swings in the market, which is not atypical of any year. If you're running a traditional platform where you're rebalancing, even with one of the rebalancing tools, but which most advisors aren't, they're using Excel or doing nothing. On those days of high volatility, what are you doing? You're talking to your clients.
Yep.
You're trying to calm them down if you're not trying to calm yourself down at the same time. And maybe you run the rebalancer once during the day. You wake up in the morning, you're like, uh-oh, big day, got to rebalance my portfolios. But the market's so volatile that there might be 2 or 3 times during the day that you can tax loss harvest. What I love about the Betterment platform is it'll do tax loss harvest in the morning because it makes sense. And if the market sells off even more in the afternoon, it'll say, you know what? We can do a better trade, create a wash sale, and do that later trade. And all the wash sale does is kick the can down the road. It's not like you lose the benefit. So you can't possibly keep up as a human, even as a human running a rebalancing tax loss harvesting piece of software, because you're only going to hit it one time a day. The technology is always on. It's always looking for the optimal way to do things. I don't think advisors understand what they're not delivering to their clients by not employing the best technology.
Yeah, and understanding what their real value is. Because if your value as an advisor is you run the best tax loss harvesting platform out there, you're going to get out-roboed, essentially. And, I like to say you can't out-robo a robo because they are technology. You simply can't beat them at what they do. What you have to do is be offering a value that they won't offer. And a real financial planner is not in competition with Betterment Institution or with Betterment in general. Advice Period is not at risk of going under because Betterment is growing. It's that I think Betterment, and therefore Betterment Institutional, is going to allow Advice Period to grow even faster and even more efficiently and bring in more top talent and keep those margins where they need to be to run a successful business because of the technology.
Undoubtedly. For those advisors that don't want to be replaced by technology, I encourage them to get rid of their iPhones, get rid of their email system, go back to snail mail, because they're constantly employing new technology that doesn't threaten them emotionally. It's only when something threatens them emotionally that they make up stories about why it doesn't make sense and it won't work. And you hit the nail on the head. We can be better. We can do more for our clients and give them a better experience by employing technology. And that's constantly what we're looking to do.
Yeah, I'm constantly running out of carrier pigeons. It's a real problem.
Well, you can only deploy so many at a time.
So Betterment Institutional is, I guess, the one that you're known for, but I have noticed, or I should say known for in terms of as an investor and advisor, I have noticed that every press release that has come out in the last 6 months seems to have your name in it in regards to investing in, different rounds of funding for tech companies. So has this always been a passion to really be involved in fintech, especially early stage technology, or is this just something that you've been drawn to as of late?
I've always been interested. In fact, yesterday I noticed, or I got an email that LastPass, for those of you who use a password tool, was acquired by LogMeIn. And I tried to invest in LastPass probably 10 years ago.
Oh, nice.
I met those guys. So I guess I've always been, it reminded me I've always been interested. The fact we started Fortigent explains some of our interest in technology. And when I really started, in 93, 94, we created our own reporting system. And so, yes, I've always been interested. I didn't have the ability to invest in technology that wasn't my own until later on, after I had some financial success. But, success has begotten success. So I got a little notoriety from being early on the Betterment side. And ironically, in 2012, 11, when I was investing, people are like, this is ridiculous. You're never going to, I was telling everybody about it. Guys, you should invest in this thing. This is stupid, never going to make it. Well, so far, so good. But because of that notoriety, I propelled me into other opportunities, and I get a good look at some of the fintech out there, and have made a number of investments that I hope pan out. So it's been a lot of fun.
So before the call, I jokingly said you were throwing money around, but you're obviously a very smart guy and you don't waste money. So do you have a strategy that you can share with us in terms of some of these different companies? Because we've seen you pop up on, I believe, Blue Leaf? I know Advisor.
No, not Blue Leaf. If you go to Lockshin.com, you can actually see all my fintech investments.
Oh,
but it's everything from Wealthbox to Quovo to FEX to Betterment, First Point, Advice Period. There's a host of them. The theme is they're all fintech, and for the most part, they're early stage venture investments.
So Wealthbox is on here. So for XYPN members, Advisor is a partner. Wealthbox is included in our tech stack, obviously Betterment Institutional. So and Quovo was one of the newer ones. For folks that don't know, Quovo is a data aggregator. Are you helping some of these companies pull together into a central tech stack? Because while some of these companies play nice, they, together, there's certainly no coherent tech stack as of yet.
Yes. So one of the things that I hope has helped these firms, and certainly I enjoy, is finding complementary opportunities. So Advisor uses Quovo. Betterment uses Quovo. Advisor and Betterment are starting to do stuff together. I've introduced Wealthbox to the Betterment folks, to the Quovo folks and Advisor folks. And one of the things that we talked about earlier is, what does the firm of the future look like? And I mentioned the term tech stack. Well, what we really want, or what I really want, is a fully integrated tech stack. So an advisor that walks in tomorrow can really start their business with a MacBook Pro and is completely intuitive, just like when you got that first iPhone, and run their business, or run their business on an iPad. And so I would like all these things to work together when it makes sense. But I do spend a lot of time helping them. I'm either on their advisory board or on their board, or just working with them to help them create a better solution that we can deploy.
Fair enough. And that's something that we're constantly searching for with XY Planning Network as well, is how do we pull all these tech pieces together? Because ultimately, technology historically in financial planning has been a little old school. It's been by advisors for advisors. And I will tell you that advisors are usually not the best people to be developing technology.
I'm laughing as you say that, because on the Betterment Institutional site, it says developed by advisors for advisors.
Oh, nice. I love it.
Well played, Alan. Well played.
to be fair, their advisors can make really good advisors to tech development, but you don't want them literally being the ones designing user interface, which is where a lot of our tech came from, was out of Access databases and Excel spreadsheets that somehow got turned into software.
Exactly.
But that's funny. I did not know that. Excellent. Get a little pie on the face. But no, and so we're always looking for how do we pull together a tech stack that is intuitive and makes sense and works together, and you're not constantly, doing these ridiculous workarounds and workflows to try to make up for the inefficiencies that exist in the technology space. And honestly, that's what I'm most excited about with some of these big sales lately, like eMoney going to Fidelity, and who else has sold recently? LearnVest, some of these other platforms, because it's allowing for some, I think it's going to bring a lot more money into the tech space, into the fintech space, because now investors are realizing there's money to be made in fintech for advisors. And so hopefully we'll continue to get better and better technology, for our folks. So
definitely. I think we're going to see a lot more investment. In fact, we're already seeing fintech is the hot space right now. The amount of money and the kind of people that are coming in to build technology for a space that is ripe for disruption are all non-industry people. And I think that's going to dramatically change the pace of adoption because they'll create better tools.
Well, and we see that because many of us are getting the emails from those folks going, hey, could we pick your brain for just a minute? Because we know we want to create technology in your space, but we don't know what you do. So tell us what's wrong. And I get one of these emails once a week. But some of those companies have actually produced some interesting stuff that's kind of shaking up, bringing in apps that never would have thought I could have needed. And yet now that they're here, it's like, oh, this is actually pretty cool. So, that it's the beauty of fintech. So we'll wrap up with the last question that I ask every guest, and I'm really interested to know what your answer is going to be. If you could go back and tell younger Steve Lockshin, and maybe this is the Steve that was thinking about breaking away and starting his own firm, or the one that left Convergent and decided to start a new RIA, if you could go back and tell yourself one piece of advice, if there's one thing you wish you had known then, what do you think that would be?
Ooh, that's tough one if it's only one. My advice to everyone is always take the high road, but that's a little too prophetic, if you will. I think it's don't be afraid or challenge the convention. And maybe it's don't be afraid to challenge the convention, because it's grow or die in any business. And if you're not constantly evolving, particularly in our industry, which is a dinosaur and is going to evolve rapidly, you run the risk of either being stuck in a lifestyle business, which is fine if that's what you choose. Just know that you chose that as opposed to having it forced upon you, or you're going to become extinct. So if you want to grow a real business, then don't be afraid to adopt new technology and create new experiences and look at things critically. I think that's one of the biggest challenges in our business. It ain't broke, so don't fix it. That's what most of Wall Street thinks. And it's going to be tough to, turn the Titanic in the Panama Canal for a lot of these folks. So we'll see what happens.
It's been one of the fun things with XYPN because we're essentially a sailboat right now. And so you can turn a sailboat real quickly, whereas, it takes a lot longer to turn a carrier, which is really where the industry has been. And a carrier may not even be big enough or slow enough to actually, give the proper metaphor, because it does turn eventually. But no, I think it's great advice. And even your first piece of advice of, was it don't be afraid? No, I'm sorry. Take the high road. Take the high road is huge, because I think that's something, people make short-term decisions that have long-term consequences, and always staying on the good side, always doing what's right for your clients, for your current boss, for your spouse. I mean, that it's going to pay dividends long-term, because those things do tend to come back and bite you in the ass. So
I think most of the XYPN members are younger than I am. I'm just at 50. And the old phrase that youth is wasted on the young is so true. I mean, I wish I knew then what I know now, but I'm always rewarded with doing the right thing or speaking the truth and taking the high road. And short term, sometimes it seems painful. And this applies to things as simple as commissions or conflicts of interest. But at the end of the day, if you do what your heart tells you to do and your gut tells you to do, and I don't mean to sound like someone's grandparents, life is so much more rewarding. And I think that's what most of your members are going for, is a rewarding experience where they're choosing to command what their future looks like and feels like, and doing the right thing, I think, is one of the most important things you can learn in life.
I love it. Couldn't agree more. Well, Steve, thanks again for taking the time to be on today. This was a ton of fun.
My pleasure. I enjoyed it. Thanks.
I hope you enjoyed this episode with Steve. He is a really, really great guy and has become such a big player in the fintech space. So I was really glad to have him on. It's not often that we get to hear from folks that have built such successful practices, sold them, and then moved on to start new companies. So this was a lot of fun to hear about his career. And it just goes to show you really can do a lot in your career. Steve probably never anticipated being, a fintech investor and starting another RIA, later on in his career, but still pretty young guy. So it's going to be fun to see what he does over the next couple of decades. This month's shows are brought to you by Betterment Institutional, a leading technology platform helping advisors scale their practice, improve their client experience, and save time. Betterment teamed up with industry veterans to build a next-generation interface for clients, automating workflows to allow advisors to spend more time with their clients. You can meet their practice management team dedicated to working with you to integrate a digital strategy into your business, providing best practices on technology adoption and integration. Check them out at bettermentinstitutional.com. Thanks so much for joining us today. We'll look forward to seeing you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.